Hey there! Here at Team Believe It, we believe every question has an answer, every problem has a solution, and everything is possible. So you're looking to get a loan, but your credit score is looking a little rough? Don't worry, you're not alone. Millions of people have been in the same boat, and guess what? They got approved, and you can too. Please subscribe to our channel, hit the like button, and share these videos with everyone you know. Now, let's dive into the top 10 strategies to get that loan, even with a less than perfect credit score. Now I know what you're thinking, Graham. A credit repair company won't magically give me a loan. And you're right, they won't. But think of them like financial personal trainers for your credit score. They're not going to hit the gym for you, but they'll give you the tools and strategies to whip your credit into shape. For a small fee, these companies will work their magic, disputing errors, negotiating with creditors, and basically giving your credit report a serious makeover. It's like taking your beat-up old car in for a detailing. It's still the same car underneath, but it looks and feels way better. And with a higher credit score, you're much more likely to get approved for that loan you need. Think of it like this. You wouldn't go to a job interview in your sweatpants, right? You'd put on your best outfit, shine your shoes, and make a good first impression. Your credit score is like your financial outfit. A credit repair company helps you put your best foot forward, showing lenders that you're serious about managing your money. And trust me, lenders love to see that. Now, not all credit repair companies are created equal. Just like you wouldn't hire a personal trainer who looks like they haven't seen the inside of a gym in years, you want to do your research and find a reputable credit repair company with a proven track record. Look for reviews, compare services, and don't be afraid to ask questions. Remember, this is your financial future we're talking about. Okay, let's talk collateral. No, I'm not talking about damage to your car. I'm talking about using your assets to your advantage. See, lenders love collateral because it reduces their risk. It's like saying, hey lender, I'm so confident I'll pay back this loan that I'm willing to put up my insert valuable asset here as insurance. Now this could be your car, your savings account, or even a piece of property. The key is to offer something of value that makes the lender feel more comfortable lending to you. Think of it like this. Let's say you need to borrow your friend's lawnmower. If you've never borrowed anything from them before, they might be a little hesitant. But if you offer to leave your brand new Bluetooth speaker as collateral, they're much more likely to say yes. It's all about building trust and showing the lender that you're serious about repaying the loan. And with a secured loan, you're not only more likely to get approved, but you might even qualify for a lower interest rate. It's a win-win. Lenders are all about one thing, getting their money back, plus interest. And the best way to convince them that you're good for it is to show them the money. I'm talking about proof of income, people. This means digging out those pay stubs, tax returns, and bank statements. Lenders want to see a consistent flow of income coming in, proving that you can actually afford to make those monthly loan payments. It's like going on a date and bragging about how much money you make. But instead of trying to impress a potential partner, you're trying to impress a lender. And just like in dating, honesty is key. Don't try to inflate your income or hide any debts. Be upfront and transparent, and let your financial track record speak for itself. The more organized and prepared you are, the more confident the lender will be in your ability to repay the loan. So, gather your documents, organize them neatly, and be prepared to show the lender that you're financially responsible and capable of handling the debt. Chapter 4. Down payment power move. Show you're serious. Alright, let's talk down payments. This is where you get to show the lender you're not messing around. A large down payment is like a giant neon sign flashing responsible borrower. Think about it. The more money you put down up front, the less risk the lender takes on. It's like saying, hey lender, I'm so invested in this that I'm willing to put my own skin in the game. Now, I know what you're thinking. Graham, if I had a ton of cash lying around for a down payment, I wouldn't need a loan. And you're right. But even a small increase in your down payment can make a big difference. It's like negotiating the price of a car. You're not going to get the price down to $100, but every little bit helps, right? The same goes for down payments. So scrape together every penny you can, sell that old guitar you never play, and show the lender that you're serious about this loan. Chapter 5. Shop around, don't settle for the first offer. Listen up, folks. When it comes to loans, you've got to shop around. Don't just settle for the first offer you get. It's like buying a car. You wouldn't just walk into the first dealership and sign on the dotted line, would you? No way! You'd compare prices, check out different models, and haggle like your life depended on it. The same goes for loans. Different lenders have different criteria and interest rates. Some lenders specialize in working with borrowers who have less than perfect credit. They might be more lenient with credit score requirements, but they might also have higher interest rates. That's why it's crucial to compare offers from multiple lenders. Check out credit unions, community banks, and online lenders. Don't be afraid to ask questions and negotiate for better terms. Remember, you're in control here. Take your time, do your research, and find a loan that fits your needs and budget. Chapter 6. Think local credit unions and community banks. All right, let's talk about the little guys' credit unions and community banks. These institutions are often overlooked, but they can be a goldmine for borrowers with less than perfect credit. Think of it like this. Big banks are like those massive department stores. They have a little bit of everything, but it's all mass-produced and impersonal. Credit unions and community banks, on the other hand, are like your local mom-and-pop shops. They're more invested in the community, they know their customers, and they're often willing to be more flexible with their lending criteria. They understand that life happens, and sometimes your credit score takes a hit. So don't be afraid to ditch the big banks and give these smaller institutions a try. You might be surprised at how much more personalized and accommodating they can be. Chapter 7. Debt-to-income ratio. It's all about balance. Let's talk about your debt-to-income ratio, or DTI. This little number tells lenders how much of your income is going towards paying off debt. The lower your DTI, the better. Lenders like to see that you have enough wiggle room in your budget to handle a new loan payment. Think of it like balancing a plate of food. You've got your main course, which is your income, and then you've got all the sides, which are your debts. If your plate is overflowing with sides, it's going to be tough to add anything else without making a mess. The same goes for your finances. If your debt is already eating up a big chunk of your income, lenders are going to be hesitant to add another payment to the mix. So how do you improve your DTI? You can either increase your income, maybe get a raise or start a side hustle, or decrease your debt by paying down credit cards or consolidating loans. It's like cleaning your plate before you go back for seconds. Chapter 8. Honesty is the best policy. Explaining your credit situation. Listen, we've all made financial mistakes. Maybe you missed a few credit card payments, or perhaps you went through a rough patch and racked up some debt. It happens. But here's the thing, lenders don't always know the story behind your credit score. They just see a number. That's why it's important to be upfront and explain your situation. If your low credit score is due to a specific circumstance, like a job loss or a medical emergency, let the lender know. Provide documentation to support your claim, such as termination letters, medical bills, or court documents. This shows the lender that you're not just making excuses, you're taking responsibility for your past and demonstrating that you're working towards a brighter financial future. Honesty and transparency go a long way in the lending world. Remember, lenders are people too, and they understand that life throws curveballs sometimes. Chapter 9. Start small, dream big, building credit with smaller loans. Alright, let's be realistic for a second. If your credit score is really hurting, you might not qualify for a massive loan right off the bat. But don't despair, you can start small and work your way up. Think of it like climbing a mountain. You wouldn't try to summit Everest on your first try, would you? No way. You'd start with smaller peaks, building your skills and endurance along the way. The same goes for credit. Start by applying for a smaller loan, such as a secured credit card or a credit builder loan. These loans are designed to help you establish or rebuild your credit history. Make your payments on time, every time, and watch your credit score steadily climb. As you prove yourself to be a responsible borrower, you'll unlock access to larger loans with better terms. Chapter 10. Patience is a virtue. Build your credit before applying. I know, waiting is the worst. But trust me, sometimes the best thing you can do is play the long game. If you're not in a rush to get a loan, take some time to build up your credit score before you apply. Think of it like baking a cake. You wouldn't just throw all the ingredients in the oven without measuring or mixing, right? No, you'd follow the recipe step by step to ensure a delicious outcome. Building credit is the same way. It takes time, patience, and a little bit of effort, but the rewards are well worth it. So how do you build credit? It's all about demonstrating financial responsibility. Pay your bills on time, keep your credit card balances low, and avoid opening too many new accounts at once. It's like training for a marathon. It takes time and dedication, but the sense of accomplishment when you cross that finish line is unbeatable. Wootro, you got this. With these strategies, you can improve your chances of getting approved for a loan, even with a low credit score. Remember, persistence and preparation are key. Good luck. As always, here at Team Believe It, we believe every question has an answer, every problem has a solution, and everything is possible. Please subscribe to our channel, hit the like button, and share these videos with everyone you know. Thank you.